Hi, I'm Asaira, and we will talk about IAS 36 Impairment of Assets. Objective seeks to ensure that entities' assets are not carried at more than the recoverable amount. IAS 36 applies to land and building, machinery and equipment, investment property carried at cost, intangible assets, goodwill, and subsidiaries associate JV at cost. IAS 36 does not apply to inventories, construction contracts, deferred taxes, assets arising under IAS 19 employee benefits, financial assets within the scope of IAS 32 financial instruments presentation, and non-current assets held for sale. So let us know what is impairment. Impairment is a fall in the value of a company's assets. An asset is impaired when recoverable amount is less than the carrying amount. Carrying amount, the net value at which the asset is included in a statement of financial position, after deducting cumulative depreciation and any impairment losses. IAS 36 suggests two indications on how we recognize the asset that is subject to impairment, and they are external and internal. So let us know the external. The first one is a fall in the asset's market value due to passage of time over normal use. The second one is significant change in the technological, market, legal, or economic environment of the business in which the assets are employed. The third one is an increase in market interest rates or market rates of returns on investments, likely to affect the discount rate used in calculating value in use. And the fourth one, the carrying amount of the entity's net assets being more than its market capitalization. The other one is internal. The first one is obsolescence. Obsolescence, it is the process of being outdated of an asset or it is no longer used. And physical damage, it is the damage to an asset whether caused by accident, fire, earthquake, or any other reason. The second one, adverse changes in the use to which asset is put. Lastly, there is possible impairment of assets when the asset's economic performance is worst. Recoverable amount. Recoverable amount of an asset should be measured as the higher value of the asset's fair value less cost of disposal and its value in use. The concept of value in use is very important. Assets fair value less cost of disposal is the price that would be received to sell the asset in an orderly transaction between market participants at the measurement date less direct disposal costs such as legal expenses. Value in use. Value in use is the present value of the future cash flows expected to be derived from asset or cash generating unit. Impairment loss is equal to carrying amount less than recoverable amount. The impairment loss is to be treated as a revaluation decrease under the relevant IAS. To extend that there is a revaluation surplus held in respect of the asset, the impairment loss should be charged to revaluation surplus. Any excess should be charged to profit or loss. If it is not possible to calculate the recoverable amount for an individual asset, the recoverable amount of the asset's cash generating unit should be measured instead. Cash generating unit is the smallest identifiable group of assets for which independent cash flows can be identified or measured. Allocating goodwill to cash generating unit. A cash generating unit comprises the following. Following our session, an impairment review has estimated the recoverable amount of cash generating unit to be 50 million. By deducting the total carrying amount of 66 million by the estimated recoverable amount of 50 million, we came up with a total impairment loss of 16 million. The loss will be applied first against the goodwill and then against the tangible non-current assets on a pro rata basis. So now we will write off the goodwill. After writing off the goodwill, the balance to be allocated is 6 million. This is prorated over the total of 36 million for the remaining non-current assets at the rate of 1 million per 6 million. So first is the building. How many 6 million can we get in 30 million? So we divided 30 million by 6 million and we came up with the answer of 5 times 1 million equals to 5 million. So the next is plant and equipment. We will do the same procedure and we came up with the answer of 1 million. And now we have the total impairment loss. So the next one is we will deduct the carrying amount by their impairment loss. So the first one is building. 30 million less 5 million is equal to 25 million. The next is plant and equipment. So 6 million less than 1 million is equal to 5 million. The next is the goodwill. 10 million less than 10 million is equal to 0. So in the current asset, we will write 20. So now we will add them. 25 million plus 5 million plus 0 plus 20 million is equal to 50 million. And now, we're done. Impairment loss. Example. A company has acquired another business for 4.5 million. Tangible assets are valued at 4 million and a goodwill of 0.5 million. An asset with a carrying value of 1 million is destroyed in a terrorist attack. The asset was not insured. The loss of the asset without insurance has prompted the company to assess whether there has been impairment of assets in the acquired business and what the amount of any such loss is. The recoverable amount of the business, a single cash generating unit, is measured as 3.1 million. Solution. Impairment loss is equal to carrying amount less than recoverable amount is equal to 4.5 million less than 3.1 million. So the impairment loss is equal to 1.4 million. The loss of 1.4 million will be allocated between the assets in the cash generating unit as follows. A loss of 1 million can be attributed directly to the uninsured asset that has been destroyed, so the carrying value for tangible asset will be now 3 million. The remaining loss of 0.4 million should be allocated to goodwill, so the carrying value for goodwill is now 0.1 million. So it's the end of impairment of assets. Thanks for watching.